itself is really huge. So that's a great program to really look out for as well. So the upcoming one will be next year. We just closed our this year's program. There's the Thai University program, which is focusing on idea stage. So basically, if you know students, universities who has their entrepreneurship department, once we launch, we take in ideas, and we've seen success stories where the 3 winners, where they were just projects, the next year they're actually, like there was even a 21-year-old who closed a funding round, you know. So it's really great to see the transformation, and the innovation really lies at that age. Thai Dubai, as I was saying, is the Middle East chapter. The easiest way for you to follow is Thai Dubai on all our channels, including YouTube, where you'll find sessions like, for example, Dr. Manoj's session today will be put up there for later consumption as well. Facebook, Instagram, LinkedIn, everywhere, Twitter, X, sorry, not Twitter. You can just look for Thai Dubai everywhere. A very special thank you to our charter members. Dr. Manoj is our charter member as well, who make all the magic happen, to the board that really helps spur the chapter forward to make all the amazing in the chapter happen. So moving on to today's session, Dr. Manoj Nakra, an entrepreneur, strategist, author, and investor who is also extremely humble with all the knowledge that he has about the startup ecosystem. Dr. Manoj is a co-founder of a startup, Skip, a SaaS company with platforms for entrepreneurs, digital infrastructure for capital investing, and incubation. So these are multiple platforms that he has. Talent acquisition. Skip manages 4 investment networks and 2 incubators. Dr. Manoj is a board member of Arvind Fashion, listed on NSE India, and Mufti, impending IPO. He has an MBA from IIM Bangalore, an engineering degree from IIT New Delhi, and a doctorate from Case Western Reserve University. I don't want to take any more of his time. Dr. Manoj, I hand it over to you.
Thanks, Cicely.
Just one thing, whenever we are opening for questions, we'd request you to use the mic, just because it's being recorded and whoever can watch it will hear the questions as well.
Hi, everybody. We'll keep it a dialogue-based journey. So can you guys read this? I'm just getting conversant with ChatGPT Kali on making images, so I said, why not start with this?
Oh, great.
So my valuation, based on whatever, company that raised a seed round of 5.5 last week. We are doing the same thing better. And the angel says, let me stop you. I don't want to discuss valuations in the first meeting. If you discuss valuation before discussing potential, I probably will not invest. Can I ask why? The job of an entrepreneur is to build a company worth 50 million in 5 years. 1 or 2 million difference in valuation on the first day doesn't make a difference. So the logic is that valuation, which ends up being a very important part of conversations, is actually an outcome of a lot of business decisions that you and I take as entrepreneurs. And valuation as a number is something which gets negotiated last. And it's influenced by many things, and I'll cover that. So this is just a summary of information which I just took off from TechCrunch. So a journaling app raises 2 million, and all these are seed rounds, the first check. Another one raises 3 million, Komi raises 5, Firmbase 12, Ambit 16, 24, and one company raises 30 million as the first check. And what I want to discover is that what is causing this? How do angels or investors take decisions rather than the valuation as a number? Because the valuation is a focal point of dialogue and often becomes irrelevant in the final signing of the term sheet. So this is just the trends of data. So one of the reasons for me to tell you this was that when you look at something, take it in, but don't register it as an important piece of information. Because why somebody like Kunal Shah raised a 30 million round at a valuation of 238 million on a pitch deck is very different from a 2 million where the product is running and just got launched on iOS. Now, this is what has been happening to the value of pre-seed valuations over time. And I'm consciously taking the period of 2018 to 2023, which covers the pandemic. Pandemic caused a very interesting phenomena. Investments actually started to go up. Entrepreneurs were rarely evaluated by investors. You can't evaluate a human being on a Zoom call. It ended up being what I call the MBA kind of an evaluation. An MBA kind of an evaluation is, forget the person, let's look at the idea. The reality is the person creates the idea, and ideas change 100% of the time. So there's no logic in looking at a deck on Zoom, and if you look at all the ed tech businesses, and I have a slide for that, what happened? It boomed during that period. A company acquired 17 companies in a period of 18 months and is now virtually going bust. Ignore what happens on the stock market. If you ever hear anybody saying that the market sentiment is weak, ignore it. The sentiment is about your business. It is not about the market, and very often about you. So if you look at it, a market investor, when the price goes up, is optimistic, and then he wants to sell, and the same cycle repeats. But what do I do as an investor in your company? I buy and I hold, and I'll show you that the average holding period is between 5 to 8 years. It's a very long-term perspective for the capital that you get as an entrepreneur. Now, you've heard the term seed capital, venture capital, and stuff like that. There's a big difference, and I want to focus on that as to how it influences your dialogue on the value of your company. So in a venture capital world, I take some money as a general partner. I'm going to manage this fund. I take money from LPs, and then I put it into a lot of investments, and I assume statistics will play out, and I'll get one big diamond over here worth $1 zillion. The reality of a venture fund is that limited partners contribute 99% of the fund and get 80% of the profit. Whereas these guys put 1% of the fund and take 20% of the profits. The assumption is that because of a disproportionate contribution to reward ratio, they will take very diligent care of the money of those guys. Actually, in the venture capital world, statistics is more important than prudent investment. But that's a topic for a separate session. In the case of early stage investors, the phenomena is very, very different from this. Usually one investor who has a domain expertise in the area in which you're trying to create your startup ends up being the person who evaluates you and your business. If he's contributing $100,000 into the startup, he probably just gives $5,000 of his own money. And one of the angels becomes your board member or a lead investor who then holds your hand to success. So the logic of early stage investment till Series A and the logic of valuation in the second round of funding or the third round of funding till Series A and beyond are very, very different. The session today is primarily focused upon early stage investment after your friends and family have given you money. You may have taken a small round from somebody else, but it's the first time outsiders come, look at what you are doing, and give you a larger check than any of the family members have. So we call it the first institutional investment. And this is why we call it institutional, because it is at this time you got to become structured in the company. It can no longer be a kitchen table startup. And compliances start to become very important. So what we traditionally do is that when we start a business, the risk is very high. No entrepreneur agrees with the statement. They think the project that they're doing is going to be the next Amazon. The reality is, building a business is a very, very tough job. I wrote a book which is 1,000 Days Adventure. That was when I was running an incubator. Now that I'm running my business and I'm running angel networks and incubators, get ready for an 8 to a 10-year ride of stress, need of emotional support, and a coffee with somebody when you really don't know what to do with the business. And that's what the check is supposed to do for you. As the investor minimizes his risk, they are supposed to support you in your journey till at a stage your business becomes predictable. And people can look at an Excel. This stage, nobody looks at an Excel. Only you do, as entrepreneurs. So we will look at this part of the story. I just took a decision to add this bottom line. In this phase of investment, if a startup business has a metaphor in the horse racing world, who's more important, the jockey or the lineage of the horse? It's a very subdued yes. Traditionally, the entrepreneur is the sculptor of the business, and the sculptor is more important than the outcome. After this, you can even sack the CEO, founder, and you can still run the business. So that's a bad word, but you find a co-founder who can run the business better than the guy who started it. So that's the story. I'm just going to look at this and I'm going to caution you, this is not a classroom. I hate Excels, so I have tables. You'll have to pardon me for that, but the tables are there for a purpose. I'm going to try to cover most of it. Where I can't, we'll flip it over for next time. Let's look at this. These are the things which Cicely told me to do. Some of them I'm not going to do. Some of them will emerge in the discussion. And as you can see, Excels in my game are banned. What makes a startup successful? How do you define it as a success? Profit? Sales?
Fills the gap in the market. The solution to a problem.
Solution to a problem?
Market fit.
Whatever. These are good words. Still, I'm searching for the answer. Sure. Everything adds up.
Client success.
Yeah, market fit, sort of.
I think it's passion.
So the passion. We are talking of the fuel which goes in, and a lot of discussions about the journey, the milestones of the journey. What is successful?
The founders.
What?
The founders.
No,
People behind the idea.
Execution.
no, no, it wasn't. I'm not that stupid. So we usually define success in the world of startup investing. When I put $1 into your company, and the 8th year you give me $30. What has happened? It's an outcome indicator of the success of your business. Everything else that you said, passion has delivered, market fit has delivered, everything has delivered. The real success is multiplication of value at a very fundamental level. You go to a bank and put $100, you get today 5% for the sake of argument. It's a risk-free return. Somebody's coming here and taking a bet on you on a pitch deck and saying, I'll give you $50,000 and I'm going to come and give you another check of $100,000 in 18 months or 12 months. What's he doing it for? He loves you? Doubtful.
It's the idea, concept.
It's some chemistry of the idea and everything put together that this guy has the capacity to change the world with nothing. And it seriously changed the world. When you don't know which door to knock to sell, and the entrepreneur comes up with how to open that door, right? So we have a company in Dubai who narrated a story to us. They started a sandwich wholesale business, and I'm talking of 20 years ago. Dubai was still big, getting bigger very rapidly. And what she did was she just took a cane basket with sandwiches and climbed the buildings on Sheikh Zayed Road, gave one sandwich to every reception lady, and left her menu and said, whenever you have a party in the office for lunch, this is the number to call. Not in any textbook, not in any Harvard case study. That's what an entrepreneur does, fights with the back to the wall and still makes it happen. Valuation is a very interesting intersection of the hopes and dreams of a founder and the riskiness assessment of the investor about the cash which he's giving to you. But there's another element to investment, which we call the fear of missing out. Anybody knows this term? Not in traditional sense, yeah, but in the investment sense. Good ideas are very few, and the capital in the world is very large. What's your name, sir?
Majid.
Majid is talking to me. Cicely comes, and I just tell him, Cicely is prepared to give me 100x, and you are prepared to give me 80x. Cicely is from Sequoia, for the sake of argument. What happens to his assessment of the business? Fear of missing out. This is the game which entrepreneurs, if they have any sense, can play extremely well if after the first 30 pitches they realized that the business which they are doing is interesting. Why do I say 30 pitches? First 10 pitches are a waste of time. You're going to change the deck every day, every hour. Your business starts to become clear. You start to talk the language of the investor. And then, if you can manage to get a couple of term sheets from somebody, signed term sheets, not the unsigned term sheets, this starts to play. So this negotiation, the word valuation is a transient phenomena. That number flexes, but what doesn't change is this and his wanting to take a downside risk. So he's assessing you for risk and you are telling him about the opportunity. The early stage dialogue is a very, very different dialogue from two sides of the story. And all valuation methods that we will discuss is directly or indirectly trying to understand risk of failure for the investor and understand market trends. Should I invest or can I wait? Should I give a quick decision or somebody else will beat me to the game? So these are all the methods. I'm going to cover a few of them. You'll get the deck. I'll give you a link. You can go and look at all of them. Let me tell you, I'm an MBA. I teach MBAs, even now, once a year. These are all MBA methods. And if you were going to tell me this is what true early stage investors use, they use it in their brain, not in the form that we will show it to you. Why will I show it to you in the form it is presented? Is to see the various thinking patterns of investors when they look at you. So you got to get a grasp of that. When an investor uses a term, what does he really mean? So we say science and an art. Again, I'll narrate a story. So because one of my platforms runs angel networks, one investment analyst can look at 3 slides of a deck, the first 3, and he knows should he even waste his time in talking to the entrepreneur. Why? Because this skill can't be taught. It's learned by investing, burning your hands, and is traditionally learned over a period of 8 to 10 years, the cycle of a startup. Otherwise, you don't know what you did wrong. How many times have you made a wrong judgment of an entrepreneur on the first meeting and you have repented it after that? A lot of investors go through this repentance, by the way. So broadly, in my session, I'm going to keep focusing on the idea, seed, and early growth. And I'm going to talk in terms of the scorecard evaluation and the VC. The discounted stuff we'll keep for next time if we are interested. It's not very complicated, and Excel sheet works very well over there. So significance of valuation. At the current moment, my communication to you is incomplete. I've communicated no knowledge. So I'm starting from 0. So I'm going to come into pre-money and post-money. You guys have heard about it? Can anybody share what it means? Yeah? Take a shot.
Pre-money is considered the valuation of the company before the investment comes into the company. And post-money is including the money that is injected into the company by the investor.
Yeah. So I'm going to break this thought process to its underlying phenomena. So when I'm an entrepreneur and somebody comes and says, you have 100% of your company, give me a part of it. My first question is, what do I lose in control? My co-founder, by the way, refuses to take external capital. She doesn't want a new manager in her life who's going to tell her every month, you haven't met your targets, and every quarter, can you change the direction of the ship? Where I know what's going to work. And second is the share of wealth. So the objective of valuation being done today and going 8 years later at 30x for the sake of argument is that whatever you shed as your ownership, you better get more wealth at the end of the day. Why do I raise this question? Because there's a very big challenge with valuation. The minute you start to take capital, every 18 months you're going to raise more capital. Nobody gives you money for longer than 18 months, which means you've got to increase the value of the company or the wealth of this pie chart, this pie, on a continuing basis. So traditionally, before you raise capital, the value of assets is say 10,000. 1,000 shares, founder has 100%. Then he comes in at a pre-dilution stage. The numbers, the maths is exactly the same. The investor says, I'm going to take 20% of your company, which is 250 shares, and I'm going to give you $5,000 because I'm going to be 5,000 divided by 25,000, 20%. So what has the investor actually done? A little simpler. That was what I call obvious. Dilution is financially wise for the founder. I'm going to come back to the answer. But for the VC, VCs now has to be patient, right? So I simply define pre-money. You had a diamond. You didn't know its value. Suddenly somebody came up, gave you a bag of dollars and said, this is $4 million post-money. What has he done? He's actually, no, not validate. He's actually told you, you created something extremely valuable. You didn't know the value of your company. I know the value of the company. implicitly validation. But please remember, on the day you take external capital, you first realize the value of your business. It's the first transaction, as it were. And then, if that happens, very few people discuss the word cap table. How many of you understand this term called cap table? What is it? It's the structure of the ownership of shares of a company, of a startup. And I'm going to show you, all of us who take external capital, managing the cap table is more important than managing valuation. I'm going to show you why. And it's funny, but rarely does anybody say, can I have a session on cap table management? There are companies like Carta, whose only job is to manage cap tables, by the way. It's $1 billion. Fundraising is a treadmill with no off switch. Once you take it, you're stuck. 5 or 8 year gap. I just want to show you. So this is an infographic of the stages of how a company grows. And I've consciously kept it at Series A. And what really happens is you start with 100% ownership. At each raise of capital raising, you are getting diluted. And when you are getting diluted, what should not happen is the value of the company should not fall. So managing the cap table and your need of funds on a planned basis over the next 5 to 8 years is a far more important phenomena, because every time capital comes in, your ownership comes down and the valuation can go up or down. And I'm going to show you, if I raise money today at 10 million, 12 months later, somebody comes and says my company is only worth 11 million. What is the earlier investor going to tell me? I got duped. He won't say it, he'll imply it. He'll change the cap table against you. He has the rights to do it, which is a separate legal discussion. How investment and the agreements that investors sign with you are equally important to this term called valuation. What rights do you give up? God forbid you come to 8 million, then
You lose almost all the control.
control is lost on the day you take your first check, because they take most of the important decision-making rights. If it goes down, the earlier investor says, you promised me that you will grow this company at a certain rate, and its valuation will be at a certain level, revenue will be at a certain level. Leave the word valuation aside. You have not achieved it. So now you are going to give me free shares to increase my ownership in the company before you take external capital. These are the way the world works. I'm reinforcing again and again. Valuation is only a tip of the iceberg. So this is an example. At the idea level, this is what happened. The promoter got 75, the investor got 25. By the time I started the launch, another person came in, my ownership fell to 60. And by the time I came to say Series A, my ownership fell to 54. I'm currently involved with a company which gave away too much ownership at the first level to somebody. Young kid, 24 years old at that time. At the second stage, he gave away some more for the survival of the company. We invested in it at the third stage, and now we are going for Series A. And his ownership has fallen to 54 at a valuation of roughly 29 million US dollars. The Series A investor is going to say, I can't let you be below 54 when I put my money in. Why? I may have the passion, but I have no ownership. And I can just take a parachute and go. I can just stop working in the company properly. So we say that managing the cap table with the perspective of the future investor so that at the time of a Series A investment, the entrepreneur has a minimum of 62 to 64%, so that after Series A, which is a large round usually, right? Because growth has just started to come up. This figure, and now what will happen? In this cap table, the earlier investors, what do you think the earlier investors should do to preserve the interest of this entrepreneur? Practical problem for all of us. Hmm? It should be valued higher.
Issue shares to the promoter
How?
through an option pool or ESOP pool, give him a higher stake.
So define options and ESOP for those who don't know. No Google. I'll come up with a simpler method, but you define.
So you want me to take the tougher?
No, you gave me the tougher answer. I was trying to look for an easier route.
So an option pool is issuing some additional or allocating some additional or let's say carving out a portion of the existing ownership which can be reallocated to promoters.
Without changing the quantum of shares?
Well, you'll always have to increase the number of shares, issue additional shares.
Give me a strategy where I don't issue additional shares and I can still take care of the entrepreneur. He or she is giving her lifeblood, right?
Right.
For making wealth for me.
So,
And I'm at a breakout stage. Growth is just going to lift off.
right.
What should I do? What should the psychology of a good investor be?
Probably take a higher share of the profits, agree on taking a higher share.
What else? Easier route, something which gives me a very clear strategy to set this right.
Can't we have shares issued for successful delivery of results?
Yeah, but you must remember the person who comes in, you're again deferring issuance of shares for the future.
Sell the shares.
Yeah. So that's the methodology of investment, so we won't go there. Can you guess what is being attempted now? Who's made the most money in this miscalculation on the cap table? Who duped the investor? Let me be transparent. This guy, right? Who took low valuation, took an extra control, and the poor fellow ended up at 54 when the growth was starting. So what's the easiest solution? Yeah. So when I get the Series A investor, I will tell him to sell a percentage of his holding and recover his full initial investment. Now his bank balance is matching, right? He still has a large holding, 22%. At just 2%, he'll cover up all his money. And he should take a small chunk, gift it to the entrepreneur. If he does it, it's the best psychology for the company. But there's an alternative route. All the other investors say, we will all get together and give shares to you. Both are things which we managed to do. Why did I raise this as an example? Valuation has these things hidden underneath, which are far more important on the journey of growth than the number. And you and I got to plan this as an entrepreneur. Very few entrepreneurs prepare a cap table which goes to show what their journey is for the next 18 to 24 months, what will be their cash needs, what is their expectation of valuation, and how much will be the dilution. And if they don't, they end up with that messy thing that has happened, but for which we found a parachute to the problem. Too much given, that's okay. Founder's motivation, I said, this is a real company. Pre-Series A, 54. First round was at 3 crores, $500,000 at that time, USD. Second was at 13, which was 2 million at that time. The pre-series A, which came in, was at 50 CR, 10 million. And all this has happened between 26 months. It's a very, very rapidly accelerating technology. And now if it's coming into the pre-series A, the decision will be very, very quick for an investor to relinquish some shares and let the money come in. What happens at pre-series A is the transition point. When external professional funds come into the story, very often all the existing investors are asked to exit. Why? Because if they believe in the company, they are going to seriously organize it correctly. At this stage, functions of the company, marketing may not be right, finance may not be right, post-sale service may not be right. Just the tech and the entrepreneur is good. And that's why the phenomena is happening. So what do? They are now influenced by the value created to do what? Take the side of an entrepreneur. Your negotiation power in the word called valuation flips the minute you can demonstrate growth. You can't talk about it. But if you can get the growth, the investors will do anything to keep you happy and your passion alive. And if it's too high a valuation, you will not get investors in the next round. They'll say it was too highly valued earlier. I'm not prepared to look at the business. It hasn't shown sufficient growth. And difficult for further rounds, you can end up with a down round. Every edtech company, and I saw investments in 3 edtech companies, still growing, still at a level of $10, $12 million revenue, unable to attract a pre-series A at the valuation that they are expecting. Because one mega edtech company called Baidu went down the hole. And there's time to close takes longer, so the entrepreneur's focus shifts from the company, and then the pressure on expectations rise, and traditionally it's a very, very stressful time. So when you do valuation, it's not about the valuation of the company. You're actually trying to safeguard your own psychology for the long term. So founder who succeeds a very high valuation will raise too less. Very simple. A founder raises $1 million at a 20 million, diluting 5%. If the cash burn is 75,000 a month, in 1 year he has to make the company worth 20 million. So you're stuck. And this, I'd rather look at a figure which are general trends, and I'm going to share some of those numbers, that when you come to a seed round, what should the ballpark number of valuation be? Then other factors come into play. This is EdTech. All values have fallen from the year 21. These are listed companies. So in the case of EdTech, large companies, listed companies start to influence what the valuation will be. Why? Because whatever the entrepreneur may tell you on an Excel sheet, somebody else's P&L is now visible and transparent. So they can benchmark the entrepreneur. So now the game plan of this journey is this number which we are talking, but more importantly is this and the growth rate. Valuation is an outcome, it's not an input. And when you start your fundraising journey, a very important question, very few entrepreneurs answer this: how much do you want to raise? They say my valuation should be, say, 2 million, give me 150,000, last me for 18 months, I'll try to grow to some level. But you have an 18-month cash flow plan, there's a buffer if things go south. Will an existing investor put money? If they say no, then you better raise 24 months. If you don't keep your existing investor happy, they may not put money. If you keep them happy, that's the easiest way to raise your second round. They all put money in and back you. And if that happens, then you assess the risk of the limits of dilution. Then you really understand the journey. So this is an Excel sheet which I can share, Cicely, if anybody wants. This basically talks of the ownership structure, which is the cap table. Then it talks of the shares, what are the new shares issued, and most importantly, it enables an entrepreneur to say, at what price am I selling, what was the date of investment, what are my shares, nature of the instrument, what valuation, you can put a number there, this is actually Excel sheet which works, money raised, post-money, % dilution. Most importantly, what's my average run rate of revenue? And if you put a multiple of the revenue, multiple of the valuation, the sheet tells you how much you should raise in the next round, what is the dilution you need to take. So this becomes an important phenomena. I've used terms like revenue multiple, ARR. I'm going to focus on that in a bit. So we traditionally say, at the first stage, I'll take 18 to 24 months. I'll take a multiple of the industry, I'm going to come to that. What is the milestones that you will achieve? And if you are going to achieve those milestones, what will happen to my return? Rarely have I seen an investor do this math at seed or angel stage. They do it on an envelope and throw it away. Why? Because nothing is proven as yet. And that's why they are betting on you. But this is the basic math that they do. And they want the entrepreneur, when he reports his performance, they want to see what's your cash burn and your revenue. They don't want to see anything else. So I kind of brought this home, and cap table, its importance, pre-money, and the significance of valuation. And then into the different valuation methods. I kind of said, learn on your own, even if you don't, it doesn't matter, but just look at it for 15 minutes when you get the deck. Why focus on valuation? It determines the return for the investor and dilution. The challenge is this. Rarely do investors see eye to eye with an entrepreneur. It ends up being a negotiation after they've decided to invest. And why do you think they do it? Once they've made you hungry for the money, you'll give a discount. So learn, if nothing else, learn how to negotiate. That's why the way to negotiate is get a couple of term sheets from other people, but genuine term sheets. I've found entrepreneurs giving forged term sheets as well. So don't do that.
There's a kind of a question that I have.
Sure.
On the term sheets, if you already have term sheets from somebody else, that means you are probably in an advanced stage talking to somebody. Won't it be unethical to then disclose those term sheets to the other guy?
Usually not. Usually we find that the person who's giving you the term sheet tells you, tell me whom you are giving it to.
No.
Because at that early stage of investment, seed, pre-seed, seed, angel, pre-seed is A, the club of investors is pretty small, right? And co-investment is very often, in today's world where you need $250,000 or $300,000 at a first stage of investment, it's not somebody that a small group of investors can put into you. So co-investment comes in the story. And then when co-investment happens, the person who gives you the first term sheets and the one you like ends up being the lead, and the other guys will not re-evaluate your business. So documentation becomes very easy, but that's besides the... So what is divergence? I kind of covered it up, but since I made the slides, I'll just kind of run through it. Anybody has heard of this term? I invest in a company and I take 5% of the angel round. In the cap table, it's 5% against my name. Shobha comes in, pre-series A. I don't invest. What happens? I'm diluted, right? So when I come in 5 years, when I sell at 60, I don't get the percentage which I invested at. So that's called divergence of valuation. If I continue to invest and retain my percentage, then I'll get the 30, the 15 multiple. And what then happens is that in 5 years, due to dilution, because of multiple funding rounds, the value of the investor share will not increase by 15x. Because of his dilution, it probably increases only by 3x. And very often I've heard in the angel network, when they're trying to get more angels, they'll say, I invested in Ola and I exited at 100. You didn't exit at 100. You exited at probably 7 or 8. But that's good enough. That's a good return in 5-7 years. So that's the divergence. So just bear this in mind, that when you talk of valuation, you're looking at a horizon, and the investor's perspective on return is much smaller than what you propose you will give it to him. Now, some angels tend to target a 5x to a 10x, and this table is to show you how many years perspective angels have. If I hold the company for 8 years and I get a 10x return, my return is what? 33. But if I get a 10x return in 4 years, my return is 78. So angels' perception of the return they expect, and I'm talking of the angel round now, is traditionally, if they manage to make 35% in an 8 to a 10-year horizon, they're very, very happy. Out of 100 investments they make, probably 3 cross the threshold. That's the traditional norm. So I wanted to just show you the duration of an investor's holding impacts the valuation discussion, impacts their expectation of return from you. And the second thing is, how long should a person hold their investment to really get the large returns? You can see the first year, second year, a lot of duds, yeah? Patience is a virtue of a sound investor. Anybody who calls you every month and says, what the hell is happening in your company? It's the guy who wants you to die. The guy who meets you once in 6 months for a coffee and doesn't discuss business and says, is it okay? Are you on track? And you say plus 10, minus 10. Is the guy who's saying, yeah, do some good work for me. And that impacts valuation and the expectation of return. So whenever you see an investor asking for a higher number from you, where do you think he lies? He or she? They're all in this category. Is it a good investor to have? Yeah, spot on. So valuation is a revelation of the psychology of the investor, much more than the psychology of the entrepreneur. So angel investors are, what do we learn from entrepreneurs? Building requires hell of a lot of capital, but we love to look for, and I'm talking as an angel, we love to look for companies which can grow to 50 to 100 million in a matter of 5 to 8 years. And in today's world, very difficult to find a WhatsApp. Very difficult to find a company which could give the product away for free and get a very large valuation. So the recommended valuation, which we say in the seed and angel round without revenue or marginal revenue, should not exceed 1 to 3. And exceptional circumstances are, if the founder has already set up a business and has taken care of his or her investors and giving them a multiple return, and he or she comes back with a pitch deck, what do you think you'll do? The Kunal Shah of Cred, the 30 million check is that. Jupiter, both companies are in the finance. Very, very large market opportunity. So the whole discussion on how much, what that discussion will be, is very much a function of the founder if they have proven themselves. Let's take a situation. I have a company in which I know the two domains very, very well in which I am. If I go to somebody to seek money, how do you think they will rate my domain expertise as a part of the valuation exercise? Should they increase the value? The challenge of an investor. Every small thing that they listen to you speak about adds up to this number. This number is only the indicative average. Everything else, I've taken a product, I've taken it to market. 15 customers have come in SaaS, 15 customers have come and said, I'm going to keep using your product. I just love it. It has a few flaws. Do it. What will happen? Changes. I say I sold my product to 100 people. I had a churn of 20. What will they say? They'll doubt the quality of my product. They'll say it's still at an early stage. And this is the dialogue of valuation, which is more important for all of us. And that's where I want to go. So these are market trends of valuations. I only got data from till 2020. If you notice, I have seed stage, early stage, late stage valuations. What do you think is wrong with this graph? Late in the evening? So we have a survival fallacy. So these were bombers which came from Germany back, and they were just trying to discover how to reinforce the plane so more of them come back. So one engineer said, wherever we were shot, we must reinforce that. Completely incorrect. If they were shot and they came back, that was irrelevant. They had to do something else to the plane. So whenever you see these trend lines of investment, right, it's a problem. You're looking at 2% of the exits as well. The valuations mean nothing to you and me. So look at all these crazy graphs that you see in magazines, newspapers. Somebody pushes a newsletter to you with really a magnifying glass. This is broadly what happens. So this is family, friends, angels, valuation scale. So this is the traditional scale for the sake of argument. You go to Y Combinator, what will happen? Somebody will test your business, hold your hand, right? If you have a famous founder. So what we tend to do is the early stage investments happen here. And the late stage can happen all over the place. Then the valuations change. The reason I'm trying to say is that this 2 million number for an average valuation of a company, only exceptional circumstances should change it. If you're sitting with somebody who's saying, I'm going to give you $1 million valuation and I want 20%, you are certainly heading for trouble later. So that's the cautiousness of this word of valuation. So for me, at an early stage, a 2 million to a 3 million number is a very good number to look at. Today, what I find at that stage even, people are saying, let the idea be only the family, get the product, get it into the hands of the customer, then the angels come in. So delay your fundraising as much as you can till your product can be given to a customer. Please make sure it's not free. The problem with free products is no customer ever gives you feedback. He says, this was free, right? So you don't understand whether what you're creating has value. But what's the time? I'm just halfway through or what? Huh? 7:05? So a few more slides, then I'll have to shift to the next week. What factors influence startup valuation? And the different valuation methods are still incomplete, so I'll have to bridge it somewhere. So this is traditionally you'll get from Google. There's something called a scorecard, checklist, VC, DCF, buzzwords, ignore them. The angel's risk is return, liquidity. If he can't exit your company after he or she has invested, they get stuck and they don't like it. So one of the parts of your pitch deck, recommended 12 slides, will be exit options. Nobody ever thinks, no entrepreneur ever thinks, just says IPO or next round. But you better do the cap table calculation. Because the angels that I work with, we do the calculation for them. How long? What's their appropriate rate of return? As I gave you the statistics to show it, and the direction of evolution. So there are certain valuation methods which are on risk of the business, and there are certain people who invest on market trend basis. What's the similar company getting value in the market? This for me is the best scorecard demonstration. Both are diamonds. Both startups are diamonds for me. I look at founders and I give them a score with a weightage. Very MBA-ish, right? Everything is an Excel with a table and a weightage. So this thing comes to 1. So this is something which I have seen already. Then I turn around and say, do I rate the founders better or something lesser? And then I get a different score and say, if that was valued at a certain figure, this will get valued at 2.3 million. I've never seen anybody do valuation this way. But Cicely will say, you haven't taught them how to value, so I had to put it in. Scorecard valuation is essentially a comparison of gemstones. And you take a geography, adjust the average valuation of the type of business, and take pre-money. Why do I talk of geography? The same company in America would get a totally disproportionate early stage valuation. And I have entrepreneurs who are always saying that company there got a better value. But what's the fallacy? One company doing the same thing is not the same as another company doing the same thing. Market traction and growth is my next most important variable. This is what traditionally a good investor or an investment analyst does after they receive a pitch deck. So they get prepared to talk to you. If they ask you a question on valuation, what is their expected answer? Usually this question is asked in the second meeting, rarely in the first. First, they just want to make sure, are you investable? So if you notice, like in the stock market, sales, EBITDA, PAT, and all that stuff will come in. And valuation is a multiple of sales or a profit or of an EBITDA. Sorry, that question mark came in correctly. It should have been a slash. Based on which we do a valuation. So very typical stock market kind of thinking. But why is it important in startups? It's important in startups at the later stage. As your business starts to get formed, right? The cost structures become okay. Then you are able to say that if the sales to valuation multiple of a startup in SaaS, which related to marketing automation, was X value, I am prepared to look at that multiple for you. So this is purely the mathematics of finance. And then you know you are coming to them at an entry level. This number is unknown. I want a 50% compounded rate every year of return. I'm going to hold it for 8 years. My targeted valuation of your company in terms of your Excel projections of numbers is going to be 57 million. This is the danger of giving over-optimistic Excel sheets to investment analysts. Only give them assumption sheets. If they are so good in their job, let them first discuss the assumption sheet. Once they agree to your basic premise of how your business is going to grow, produce an Excel. And this is very simple math. 57x into 1.50% every year, and you can get the valuation. And then you do a pre-math, pre-money math, and that. Where do you get the return expectation? These are standard, these are well-known valuation guys. They keep saying that if somebody invests in a seed idea, this is my expectation. If I come in the expansion stage, I'm able to take a lower number. So the expectation of an investor's return from your startup are well-established principles and averages. Enterprise value is a multiple of companies in the same industry. So you take a fifth-year revenue, multiply with the revenue multiple, and you get the number. Now you'll understand all this. These guys are all valued at multiple of expectation. This is valued at expectation of what Kunal can do, an expectation of what Jitendra Gupta can do. Both of them ran finance companies before, and both these investments are in the finance domain. So their expertise. What is the other expertise? If a Jitendra Gupta has run a startup for 22 years and Kunal for, I think, 12, what is the second thing that they have learned?
They've done the journey of entrepreneurship.
No, which part of that, Shobha? When Manoj is starting his first startup, I tend to do a lot of work to overcome the low caliber team that I've recruited, right? I haven't learned, even though I've run a company for 20 years, I have not yet transferred that skill to say I will pay a large value to an exceptional team member and bring them into the team, and then I will do other things and make the company grow. So these guys have done that. So you can, investor then tolerates a 280 million cash burn in the second year from a Kunal, because he can see that he's creating a company. Yeah? So very, very interesting dynamic plays out for a first-time investor, a first-time entrepreneur who's yet to demonstrate skills of team management and recruiting good guys with ESOPs, no cash. Whereas somebody who is saying, I'm scared, I don't have the capital, Manoj Nakra for that matter, I will not recruit a highfalutin guy, I will do the work of that person till my company gets the cash burn under control. What happens? Rate of growth of my company will be far slower than Mr. Kunal Shah. What does the investor want? Rate of growth. That's why I haven't taken capital. So I already mentioned to you, if Sequoia is investing, all the angel investors will line up, flips the value. Fragmented industry. Any industry which is fragmented and you can do something dramatic will be valued very, very high. Finance, retail, e-com. Anybody can start an e-com business. And then if you can show traction, and then if you can show a track record. 4 variables which change the dialogue completely. After you do a valuation on a multiple, then you do a sensitivity for yourself. Don't ever show this to somebody. What does this give you? When you are having a dialogue and somebody is asking a valuation much higher than what you are talking about, right? Or lower, you immediately know that their expectation of revenue potential is distorted. So you know where to discuss. Otherwise, what happens is you're discussing valuation 10 million, valuation 9 million, valuation 11 million. Discuss the basics. Talk about what's the IRR expectation. I'm valuing my company based on giving you a return of 50% over an 8-year horizon. I'm confident that I can do it, and therefore my valuation should be this. So that's your negotiating tool, actually. So this is the link. Once you get the deck, you can go in. I'm going to close here. Been a little heavy, I guess. Huh? So I have about half the slides left and next time's program, so I'll do it at that time. What I want you to do me one favor, those of who you wish to play the game, I think Cicely's trying to arrange for some investors to come. And if you come up with a valuation for your business, we can discuss it offline and let's do a dummy negotiation. That's the manner in which the whole thought process will get inculcated. And you needn't there's no right or wrong in this, right? Valuations are a struggle over a period of time. But an understanding of what in your business is influencing that number and what is its perception to the investor is far more important. Yeah. There's another part I wanted to just quickly share. So I have built a tool which, so this is like a team, right? You are able to rank the stage of evolution of your business, and as you evolve, the risk of your investment in your business diminishes. So take for a team, you have a team with different skill set. It has senior management members who have understood and worked on the problem in a previous birth, if I may use the term. The ability to make a product. Each element de-risks your investment. And when you get into customer acquisition, if you have a proven sales record or you just have a team which understands sales, the changes, and by the time you reach, if you have a CEO who's done this before, their recognition in the industry enables a much faster traction. So I've done this for various elements of a business like a value proposition. It's the same way. How much of the cost structure has got done, customers love the product, the churn, etc. I can share this link with you, you can look at it, you'll be able to kind of get a feel of what is this word called risk. Yeah? This is a tool which I used in one of my angel networks. We collected data of all their past investments, which of them failed, which of them succeeded, and we created a questionnaire which took 4.5 minutes to complete. And we used to get a score. And what we found is that any score between 50 to 60 was a business which had fewer risks to look at. So this was not a scoring mechanism to decide. I'm an MBA, so I hate these scoring mechanisms. They're all indicators of what dialogue you should have with the entrepreneur, as opposed to saying what's good or bad. We have this tendency that a score which is closer to 100 is better than a score which is 60, right? That's the distortion we carry. And that's why scoring is terrible. Yeah, so I'll share links to this. You can look at it at your own leisure. If you then have a question, we can have another dialogue. Yeah, anything?
Any questions?
My name is Reza. Hi. It was really nice. It's sunk in, you know. When it started, it wasn't sinking in, then it started sinking in.
Thank you.
So I look forward for the next session. And you were saying that you're going to share the slides with us.
Yeah, I
So
usually
you're
do.
going to share the half of it, whatever we have gone through, and
I can share the whole thing, doesn't matter.
so
It
because
does,
you know,
it's not invaluable. Its valuation is 0.
I don't think so. You know, knowledge
Yeah.
always has more value.
Yeah. Yeah.
Also, you know, so that will help us to come up with more questions.
Sure.
Because it is interesting that it is in two parts, you know. I have never been to something which is in 2 parts. So if we have this data with us, we can come up with more questions next time.
Yeah, I think what would like you to do is that the link that VC Circle or whatever that link is, have a look at it. Don't do anything if you don't want to. Excels I hate. But anybody who loves Excels, you can look at it. The two links issues on the UI UX out. If I can manage to do it over the weekend, I'll send that as well. But the questionnaire for scoring, you should look at.
Perfect, thank you.
Yeah.
Have come without registration. So just make sure your emails are in. Thanks.
How many of you have raised money? Good. I should have brought you in the front row. What stage of the startup was that?
First round, see.
So how much valuation you took?
We took a 10 million valuation.
And you had revenue before?
Yes, we are a 2-year-old business and we are doing $45,000 per month.
Yeah. So you can kind of connect the numbers, right?
He's one of our mentees.
Hmm.
One of the reasons, I mean, I've seen him across time figuring the things out. He's very passionate about the product, but sometimes you struggle with putting the numbers right.
Yeah.
Right. So I find that a lot of founders.
Yeah. And who else?
What line is this, the 2 years and stuff? What line is this?
So to be honest with you, so we started 3 years and a half. Our first idea failed and failed miserably. Like we killed that business after 1 year and pivoted the whole idea. And we figured out early that we invested everything we had as a co-founders. We invested our own money, credit cards, personal loan. And we figured out later that we were not supposed to do so, and that was a mistake. However, we believed so much in the idea that we went all in. And we tried all the mistakes that we have done with the first startup to, not to repeat those kind of mistakes. So in the first startup, we were building a product thinking that it will fit everybody. And then when we started to sell, nobody wanted that product. So the second startup started on the opposite way. We actually started to talk to people, and we figured out a gap, and then we built the product. We come from the industry. We have been in the industry for 15 years. But again, when we started to build our first company, we didn't talk to anyone. We thought like, we are genius. We know everything. And I think that was one of the mistakes which we tried to fix in our second startup. And yeah, that's, we've been working on, we launched our first product, and when we found, let's say, a product market fit, we launched our second product, which have way better results than the first product. And we keep the vision and just tackling multiple products through the roadmap. We are in an industry called communication platform as a service, which means a unified communication industry and AI. What we do is we enable businesses to use AI and unified communications with no code. So we enable businesses to communicate with their customers in multiple segments. It can be security, customer engagement, customer support, sales, marketing, on all the channels like email, SMS, WhatsApp, Instagram, etc., but with no code. So what used to be exclusive for big enterprises and costed huge amount of money and took years to build can be done within minutes now at $99. Yeah.
Yeah, and there was another entrepreneur who had taken capital. How much? And what industry?
It's in Web3. It's called Moonrig. We launched 2.5 years ago. We raised in the first month itself from friends and family. We raised $154,000. I think we fell into the second trap that you mentioned, where we said we don't need the money, we don't need the money. We kept delaying it out. We have now started the next fundraise, looking at a valuation. we launched on the 3rd of October last year. In March itself, we hit about 118,000 users, but free. So we've not yet monetized. We're still continuing to be pre-revenue. Fundraise starting now, which is when I got the Thai event invite and I said, this should be interesting. So that's, and we're in Web3.
So we're very early. I got like $3,000, right? And we're able to generate like $10,000 in revenue. And we have the customers, then we start to build the product. And now we're looking to raise money to build, the product. Yeah, it's just very small.
No, small doesn't matter. The best matter. Yes.
Does the number of founders change the valuation of the company?
100%. Two founders rarely fight if they have an agreement. Three if they have an agreement works. Four if they have agreement, I'll take a bet they'll win.
But is it a disadvantage being a single founder?
100%. My co-founder and I never take the same flight till today.
Yeah, sure.
Correct? And we haven't raised capital. But we have customers who are paying us, right? These are very conscious issues, right?
Also complementary skill sets, if you can find a partner, before you have gone to war before, not an angel, but, a known devil.
Complementary skills who love to fight in a closed room, not in public. The churning of the intellectual capital of two founders is invaluable for the growth of the company.
So, it's not a question, but I actually understand. So, so what you said, that a co-founder and yourself, if you can really fight in a closed room. So, I used to hate it. We've got into wars. Thankfully, he's not physically in this region, Dubai.
Zoom fight.
he's in Oman, and another part we were together here. And over the WhatsApp, mails, and even picking up the phone. So, and I hated it, how can he say this to me? No, I can't let this, even if it's 1 or 2 at night, no, I've got to counter. But yes, as a result of that, I'm sitting here today where I entered, I had no clue, and I said, why should I go to the valuation round? No, you do that because you're pitching to the investors. I'm just getting the business. But I really understand that value of this fight in a closed room and to get back at you things which you may have thought, no, you know it all and you're this thing, but it's totally new and it's been
So there
very
are
good.
three things you should never do on WhatsApp. Manage HR and do discussions about issues because it's an emotionless piece of SHIT. Be conscious of this. Lot of fights I know have happened on WhatsApp. People have got sacked on WhatsApp and then it just becomes a never-ending, typhoon which just goes through the company and ruins everything. So just do your unified platform, put a no HR, no discussion. And ask for premium money. Premium pricing.
What if two founders are discussing, say, not in text, but in recorded messages?
I'm very wary of WhatsApp because very often I get a message, I react. I'm a tube light, I'll be very frank. So I love to get information, reflect on it and respond.
Actually, yes.
So I kind of have tried to control reactive messaging and WhatsApp is a very big problem for us.
Yeah, very impulsive. It can be pretty impulsive.
I think it's better if you go.
Yeah.
What do you think the opposite person should take time to look at the mistake? Because then you realize that you've done a mistake and you can delete it. So I use that feature a lot.
Yeah.
I'm trying to understand raising money with SAFE. Do you have to talk about valuation or just the safe text that like you have the safe and you don't need to talk about valuation.
No, safe as a safe note.
Yeah.
So when we take early stage money, very often an investor will say, I don't know how to value your company. So I'm giving you money to grow the business. If you're able to get investors after 18 months at 100 million for the sake of argument as a round number, then you will issue shares to me at 70 million. Discounted value.
I see.
So traditionally, like I have been offered $500,000 investment in my company. I declined. They turned around and said, I'll give you a term sheet. When you need the money, you draw. And I won't, so my conditions for investment into my company are, you're not going to harangue me. I mentioned that already. He said, I won't harangue you. One board meeting every quarter. After 3 years, we'll come and discuss the business. And give me a 35% discount at whatever valuation you raise capital after 3 years. So that's very reasonable. I haven't taken the offer, but that's the manner in which people are prepared to work with you.
Discount.
Because valuation is a very crazy word if you don't have revenue or don't have customers. So you're saying when you get customers 18